Alibaba has fallen, China is in deep crisis, we are all done for. So what the happened to Alibaba? Looking at the spectacular chart of Alibaba, it's currently down 27% from its recent highs of around $122, and it's still down 25% on the year-to-date basis. So I guess this is a true test of whether your hands are really diamond or not. Jokes aside, we have a long laundry list of problems to go through in this video, so remember to help smash that cute little like button on your way out. Also, this video is sponsored by Weibo. So in case you didn't know, Weibo recently leveled up their game. From now until the 1st of August 2022, every single new sign-ups can get up to $120 USD worth of Microsoft shares. I'll leave the link and instructions down below. Essentially, you just need to deposit a minimum sum of 2,000 Singapore dollars and execute a total of 6 trades in the first 30 days. So 120 USD reward for depositing 1,400 USD. That's an 8% ROI in 1 month. Definitely better than Alibaba. Jokes aside, Weibo also allows for investing into fractional shares. And I don't know why this is not a common feature for other brokerage platforms. So they pride themselves in zero commission trading as well. Don't let this 8% ROI deal get away. Link in the description. Now, getting back to the video. So I will adopt a top-down approach where I speak about China in general, then start tunneling to the industry and then the company specifically. So in general, China is sticking to its guns with regards to their overall pandemic control strategy. So just recently, Wuhan is limiting movements in some areas after finding 4 asymptomatic cases. Just 4. China is not showing any signs of moving away from zero COVID. Although many commentators are frustrated with China's decision, businesses and consumers alike are at the mercy of the government's decision. So an example, like Foxconn, the maker of Apple's iPhone, have been asked to operate inside a closed-loop system for 7 days in Shenzhen as the city battles another outbreak. So lockdowns, restricted movements, and strict controls is just another normal day in China, and supply chains continue to operate at suboptimal levels. So moving on, the property sector seems to be slowly imploding on itself back in China. Recently, another Chinese developer, Shimao, defaulted on their $1 billion bond. So Shimao was ranked as China's 22nd biggest by sales in the first half of the year, and it was once considered one of the country's stronger developers. A Singapore bank, UOB, is also currently suing Shimao Group in Hong Kong, adding to the broader signs of growing investors' impatience amidst the nation's worsening property debt crisis. So to make the matters even worse, Chinese home buyers today are refusing to pay mortgages on their unfinished apartments, and this quote-unquote boycott is essentially adding fuel to the liquidity fire that a lot of all these property developers are currently in. So according to multiple state media reports, buyers across 18 provinces and 47 cities have stopped making payments since the end of June. So in the state's attempt to quote-unquote instill confidence back into the market, 7 major bank lenders said that they believe the risks were manageable and that the Chinese authorities were holding emergency talks with banks. And of course, these are all quote-unquote propaganda talks. So the PBOC has also cut the 5-year loan prime rate from 4.6% to 4.45% in May, making both outstanding and new mortgages cheaper, essentially trying to steer up demand. So the China Banking and Insurance Regulatory Commission has also requested banks to increase lending to property developers in order to help them complete unfinished housing projects. So that said, even though banks may not want to extend lending facilities to some of these developers from a commercial perspective because they're afraid of the risk, they probably have to because it's a socialist country, you know? Wink wink. The next big topic is of course because of the China bank run. So I wouldn't spend too much time harping on the same point. I've previously made 2 separate videos talking about the bank run. Long story short, the local banks of China basically skirted many of the regulations in place and offered marginally higher interest rates, and the locals decided to not bank with the big 4 state-owned commercial banks, but instead bank with the local banks. Don't ask me why, ask them instead. So ultimately, it's not the big 4 China banks that are experiencing a crisis, by the way. It's your Tom, Dick and Harry banks. On top of that, my friend also recently notified me of the Tiananmen 2.0 that was blowing up on Reddit essentially. Headlines was pretty crazy, not going to lie. Crazy footage of tanks now on the street in China to protect banks from protesters. When I first read the headline and saw the footages, it was utterly convincing because hey, it's probably not the first time that China is doing something like that, and they kind of did it before when the entire country was in a mayhem. Then, when you click into the video, the bystanders were so calm. There were no protests at all, and the only protesting I see are in the sub-threads on Reddit where the netizens are getting so riled up, even more riled up than some of the bank protesters. Soon after, it was confirmed that the video was actually showing a Chinese military exercise in Shandong, which is more than 400 kilometers away from Henan province, which was where the bank protests were occurring. So I guess that's why it's so easy to convince people on the internet. So I will discuss this in greater details in a separate video on this problem of fake news. Next, China's top leadership team met last week to discuss the economy, inflation, property market, and the relevant credit needs. So the leaders called for stabilizing the property market in that meeting, but the readouts distilled from the meeting itself did not mention about a 5.5% GDP target for 2022. So this essentially suggests that big stimulus is currently still not considered as a viable option to quote-unquote resuscitate the economy. So truth be told, I think the Chinese government probably developed some sort of PTSD from the stimulated economy in the West and are now weighing their options. Speaking about the West, the US-China tension recently escalated again, unnecessarily. So President Biden and President Xi spoke again for the 5th time, and it still revolves around the situation in Taiwan. So just recently, Speaker Pelosi floated the idea of visiting Taiwan during her trip to the APEC region, and this has faced huge amount of backlash and pushback from the China counterparts. So it is now basically a you fly over, I'll shoot you down, versus let's see if you dare to shoot me down kind of scenario. So till now, I have zero clue why Pelosi decided to poke the bear, especially in such a politically sensitive time for Chairman Xi. Furthermore, nothing substantial came out from the Biden and Xi conversation. So many people were expecting a removal of tariffs on Chinese imports. But honestly, like what they do best, it has been no action, talk only. Zooming into Alibaba specifically, we had 3 major news. So to talk about the good first, Alibaba plans for a dual primary listing in Hong Kong, basically to appeal to mainland investors via the Stock Connect program, similar to Tencent. So it can probably be seen as a preemptive move in the event that the US-China audit talks fall through and Alibaba have to be delisted accordingly. So having a primary listing in Hong Kong will allow Alibaba to be included in the Shenzhen Hong Kong Stock Connect, which gives investors in mainland China access to the stock itself. So after this news specifically, Alibaba shares popped up by 6%. But I guess even with such great news, it's not enough to hold Alibaba's current valuation. Next, which I think has a more severe impact, will be the rumoured plans of Jack Ma ceding control of Ant Group. So long story short, Jack Ma currently controls around 50.5% stake of Ant Group, despite not holding an executive role on Ant or sit on its board. So of course, according to people familiar with the matter, the PBOC has yet to officially accept Ant's application to become a financial holding company. And Jack Ma's intention to cede control of Ant Group might be the final key to allow for Ant to proceed on with the IPO again. So on the surface, regulators definitely didn't demand the change, but have given their blessings. But who knows what happens behind the scenes. So despite the potentially good news of Ant going IPO again, investors are not only skeptical, but it also publicly displays a crude treatment towards shareholders. Welcome to China. Next, it would of course be HFCA again, Holding Foreign Companies Accountable Act. I don't know how much longer people wish to play around this delisting news. I thought it was old news, but that's beyond my control. Anyway, last but not least, Alibaba is expected to report earnings in the upcoming week on the 4th of August 2022, and analysts has been constantly downgrading their estimates. Because of? Who knows? So revenue for this quarter is expected to be 30.21 billion United States dollar compared to last year's figure of 31.86 billion. So that's a negative 5.2% year on year. However, if you were to look at the renminbi denomination to cancel the FX effect, they did 205 billion renminbi in 2021 and they're expected to do 203 billion renminbi this quarter, and it's a negative 1% growth year on year. So earnings per share is also expected to contract by 40%. So with this sort of consensus, what kind of price action do you expect? So with that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!